If you are retired or if you are within 5 years of retirement and you have received a letter from the IRS in the past 90 days, or if you receive one in the coming weeks, what I am about to tell you right now is not something you can afford to dismiss, because there is a specific category of IRS correspondence that is going out to retired Americans right now in significant volume, and the retirees who are setting those letters aside, assuming it is junk mail, assuming it is a mistake, assuming it can wait until they get around to calling their accountant, are discovering weeks or months later that their inaction has added thousands of dollars to what they owe. In some cases, the additional amount from simply not responding in time has exceeded $3,000. In others, it has been significantly more. I'm going to tell you exactly what these letters are, exactly what they mean, exactly what happens if you ignore them, and exactly what you need to do within a specific window of time to protect yourself. I am going to walk you through every category of IRS notice that is currently being sent to retirees at elevated volume, explain the deadline attached to each one, explain the penalty structure that activates if those deadlines are missed, and give you a clear and specific action plan that you can begin executing today. Stay with me through the entire video because the category of notice I am covering last is the one that is generating the largest unexpected tax bills among retirees right now, and it is the one that almost nobody sees coming because it does not look like a problem until it suddenly and very expensively is one. Before we go any further, if you have a parent, a spouse, a sibling, or a friend who is retired and who handles their own tax correspondence, please share this video with them right now, not at the end. Right now. IRS response deadlines are hard deadlines. They are not suggestions. They do not extend because you did not understand the letter. They do not pause because you are waiting for a convenient time to deal with it. Every day of delay after a deadline passes is a day the penalty clock is running. One share takes 3 seconds and it could save someone thousands of dollars. Share it now, then come back, and we are going through all of this together. Why retirees are being targeted. Right now. I want to start with context because understanding why this is happening now and why retirees specifically are receiving these notices at elevated rates will help you understand the urgency in a way that a list of letter types alone cannot convey. The IRS runs on a system of matching. Every year, financial institutions, employers, pension administrators, Social Security, brokerage firms, banks, and retirement account custodians send information returns to the IRS. These are the 1099 forms, the SSA-1099 forms, the 1099-R forms for retirement distributions, the 1099-DIV, and 1099-INT forms for investment income. Every dollar of reportable income that flows to you from any of these sources is simultaneously reported to the IRS by the institution paying it. The IRS then runs an automated matching process that compares what was reported to them by those institutions against what you reported on your tax return. If the numbers match, nothing happens. If they do not match, the system generates a notice. For the 2023 and 2024 tax years, the IRS significantly expanded its automated matching capacity and updated its systems to include new categories of cross-referencing that were not previously part of the standard match process. This expansion was funded through the Inflation Reduction Act, which allocated substantial resources specifically to IRS enforcement and technology modernization. The result is that discrepancies that would previously have gone undetected or been deprioritized are now being caught at a far higher rate. And retirees are disproportionately affected for a specific and understandable reason. Retirees typically have more sources of income than working Americans of the same economic level. Social Security, one or more pension payments, IRA or 401k distributions, dividend income, interest income, potentially rental income, potentially part-time employment. Each of these income streams generates its own information return to the IRS. Each one is a potential mismatch point, and the more sources of income you have, the higher the statistical probability that something on your return does not precisely match what was reported by one of those institutions. Add to that the complexity of the rule changes I described in previous videos, the RMD updates, the inherited IRA enforcement, the Roth conversion aggregation rules, and you have a population of taxpayers who are navigating genuinely complex tax situations with rules that changed significantly in recent years, filing returns that in many cases contain errors that are honest and understandable, but that the IRS automated system treats the same way it treats intentional misreporting, and you understand exactly why retiree mailboxes are seeing elevated IRS correspondence right now. Notice Category 1, the CP 2000. Notice the CP2000 is the most common IRS notice being sent to retirees right now, and it is the one most frequently misunderstood, set aside, or ignored with expensive consequences. The CP2000 is not a bill. It is not an audit. It is a proposed change notice. What it means is that the IRS automated matching system found a discrepancy between the income reported on your tax return and the income reported to the IRS by a third party, and the IRS is proposing to adjust your tax liability to reflect what their records show. The notice will show you exactly what income the IRS believes you received, from which source, and how that compares to what you reported. It will then show a proposed additional tax amount based on that discrepancy, along with any interest that has already accrued from the original filing deadline to the date of the notice. Here is where retirees get into serious trouble. The CP2000 gives you 60 days to respond. That 60-day window is stated clearly in the notice. What is not always clearly understood is what happens if you do not respond within that window. If you do not respond to a CP2000 within the 60-day response period, the IRS treats your non-response as agreement with their proposed changes. They then issue a statutory notice of deficiency, which is sometimes called a 90-day letter. At that point, the proposed additional tax becomes an assessment, meaning it is officially what you owe. You then have 90 days from that notice to either pay the assessment, enter into a payment arrangement, or file a petition with the tax court to dispute the assessment. If you miss that 90-day window as well, the assessment becomes final and the IRS can begin collection actions, including liens and levies. The penalty structure that activates once an assessment is made includes a failure to pay penalty of 0.5% of the unpaid balance per month, capped at 25% of the total amount owed. On a $10,000 assessment, that is $50 per month accumulating until the balance is paid. It also includes interest at the federal short-term rate plus 3 percentage points, currently running at approximately 7 to 8% annually, compounding daily. Many retirees who receive CP2000 notices do not actually owe the full amount proposed. The discrepancy that triggered the notice is sometimes an error on the part of the reporting institution. Sometimes it reflects income that was reported correctly, but categorized differently than the IRS system expected. Sometimes it reflects a basis amount that was not properly communicated to the IRS, meaning you sold an asset and paid tax on the full proceeds when only the gain above your cost basis should have been taxable. The critical point is this: you cannot benefit from any of these corrections if you do not respond. The IRS does not investigate on your behalf. They propose the change based on what their data shows. If your data shows something different and you can document it, you must respond within the 60-day window with that documentation. If you do not, the proposed amount becomes what you owe regardless of whether it is correct. If you have a CP2000 sitting on your desk right now, the first call you make this week should be to a tax professional or to the IRS directly at the number printed on the notice. Do not wait. Notice Category 2, the CP14 and CP501 through CP503 balance due notices. These notices are less complex than the CP2000, but they are generating significant additional costs for retirees who are not responding promptly. The CP14 is the IRS's initial balance due notice. It means the IRS believes you owe money from a previously filed return, either because you filed a return with a balance due and did not pay it, or because of a previous adjustment that created a balance. The CP501, CP502, and CP503 are follow-up notices sent at roughly 5-week intervals if the original CP14 is not addressed. The reason these are particularly relevant for retirees right now involves the intersection of the new RMD enforcement and estimated tax payment requirements. Many retirees who took larger than usual IRA distributions in 2024, either because they were adjusting to the new RMD calculation tables or because they executed Roth conversions under what turned out to be incorrect pro rata assumptions, found themselves with larger tax bills at year-end than their estimated tax payments had covered. When the 2024 return was filed, those retirees either paid the balance due at filing or in some cases filed the return without full payment, intending to address it shortly after. If the full balance due was not paid by the return's payment deadline, interest began accruing from that deadline date. If it remains unpaid, the failure to pay penalty is also accumulating. The CP14 is telling you that clock has been running. Every week you do not address it is another week of penalty and interest accumulating on the unpaid balance. The IRS offers payment plans for balances that cannot be paid in full immediately. A streamlined installment agreement for balances under $50,000 can often be established online in less than 30 minutes through the IRS website, and it stops the failure to pay penalty from escalating to its maximum rate while the balance is being paid. But the installment agreement must be established proactively. The IRS does not automatically offer you a payment plan because a balance is outstanding. You must request it. If you have a CP-14 or any follow-up balance due notice, do not wait for the next notice in the sequence. Each successive notice in the CP series is sent after additional penalty and interest have accumulated. Address it at the first notice and you minimize the total additional cost. Notice Category 3, the Letter 6419 and Advance Premium Tax Credit Reconciliation issues. This category is specifically relevant for retirees who are between the ages of 60 and 65, meaning they are not yet on Medicare, and who obtained health insurance through the Affordable Care Act marketplace during 2024 if you received advance premium tax credit payments during 2024 to help pay your marketplace health insurance premiums, and if your actual 2024 income turned out to be higher than the income estimate you provided when you enrolled, you may owe a repayment of some or all of those advance credits on your 2024 tax return. For retirees, income surprises of this type commonly come from Roth conversions, from larger than anticipated IRA distributions, from the sale of appreciated assets, or from Social Security benefit adjustments. If any of these pushed your actual 2024 income above the estimate you used when enrolling in marketplace coverage, and if your tax preparer did not account for the reconciliation on Form 8962, you may have an understated liability that the IRS will identify through its matching process and will address via a CP 2000 or similar notice. The additional amounts owed in these situations can be substantial. Depending on the amount of advance credit received and the income overage, repayment obligations of $2,000 to $5,000 or more are not uncommon. And unlike many other tax situations where there is planning flexibility, advance premium tax credit repayments are generally not subject to abatement for reasonable cause. You received a benefit based on an income estimate. If the actual income was higher, the repayment is mechanically required. If you received marketplace health insurance in 2024 and you experienced any income events that were higher than expected, verify that your 2024 return correctly reconciled the advance credit payments on Form 8962. If it did not, a corrected return filed proactively will be treated more favorably than a CP 2000 response after the IRS identifies the discrepancy. Notice Category 4, the CP 508C and passport certification notices for seriously delinquent tax debt. I am including this category not because it applies to the majority of retirees receiving IRS notices right now, but because the consequences of reaching this stage are so severe and so irreversible that every retiree needs to understand what the escalation path looks like if earlier notices are ignored. The IRS has the authority under federal law to certify taxpayers with seriously delinquent tax debt to the State Department, which then has the authority to deny or revoke that taxpayer's passport. Seriously delinquent tax debt is currently defined as a tax debt exceeding $62,000, including penalties and interest, that has a tax lien or levy in place. The CP-508C is the notice the IRS sends to inform you that your debt has been certified to the State Department. At this point, your existing passport may be revoked or your passport renewal application may be denied. For a retiree, the implications of this extend beyond travel inconvenience. A valid passport is frequently required as identification for financial transactions, for certain Medicare and Social Security administrative processes, and in some states for certain legal proceedings. Having your passport revoked or your renewal denied because of a tax debt that escalated through a series of ignored notices is a situation that creates cascading complications entirely separate from the debt itself. The path from an initial CP 2000 to a CP 508C passport certification runs through multiple notices over many months, each of which represented an opportunity to address the underlying issue. Retirees who find themselves at the CP 508C stage almost always arrive there not through a single catastrophic failure, but through a series of smaller decisions to defer, delay, and avoid dealing with earlier correspondence. Do not let a manageable CP 2000 become an unmanageable escalation. Address every IRS notice at its earliest stage. The notice. Almost nobody is talking about the 5071C identity verification letter. This is the one I told you to stay for, and it is the one generating the most stress and the most costly mistakes among retirees right now. The IRS 5071C letter is an identity verification notice. It does not mean you did anything wrong. It does not mean you are being audited. What it means is that the IRS received a tax return filed under your Social Security number and their system has flagged it as potentially involving identity theft. They need you to verify that you are the one who filed the return before they process it and issue any refund. Here's the problem. Millions of retirees are receiving 5071C letters right now because tax-related identity theft targeting retirees specifically is at historically high levels. Criminals obtain Social Security numbers and personal information and file fraudulent tax returns early in the filing season claiming large refunds before the actual taxpayer has filed their own return. When the real taxpayer then files, the IRS system flags the duplicate filing and sends the 5071C to the address of record. The 5071C gives you a specific window to verify your identity, either through the IRS Online Identity Verification Portal or by calling the number printed on the letter. If you do not complete the verification within the window specified on the notice, the IRS cannot process your legitimate return. Any refund you are owed will not be issued. And in some cases, if the fraudulent return has already been processed and a refund issued to the criminal, the resolution process can take many months and require extensive documentation. The reason this notice is generating the most costly mistakes is twofold. First, because it looks different from what most people expect an IRS letter to look like. It is not asking for money. It is not proposing a change. It reads almost like an administrative request, and many retirees deprioritize it or set it aside, assuming it is routine. Second, because the scam environment around IRS correspondence is so pervasive that some retirees who are appropriately skeptical about fraudulent IRS communications also become skeptical about legitimate ones. They receive a real 5071C letter from the IRS, and they assume it is a scam because they have been warned about IRS scams. They do not respond. Their legitimate return goes unprocessed. Their refund, which may represent a significant sum on a fixed income, is not issued for months. If you receive a letter from the IRS with the number 5071C printed on it, it is a legitimate IRS notice. Verify the letter is genuine by going directly to irs.gov and using the IRS's own tool to confirm notice authenticity before taking any action. Then complete the identity verification through the IRS's official channels only, either the online portal at idverify.irs.gov or by calling the number printed on the letter. Do not call any other number. Do not click any link sent to you by text or email claiming to be related to IRS identity verification. Go directly to the official IRS website and proceed from there. What you must do right now. Let me give you the action list because everything I have covered becomes actionable only if you know exactly what to do with it. The first thing you need to do today is go to wherever you sort your mail and look for any IRS correspondence you have received in the past 90 days that you have not addressed. Look specifically for envelope return addresses from the Department of the Treasury or the Internal Revenue Service. Do not discard anything without reading it. The second thing you need to do is read every notice you find and identify the notice type by the number printed in the upper right corner of the letter. CP 2000, CP 14, CP 501, CP 502, CP 503, 5071C, letter 6419. Each of these has a specific meaning and a specific required action I have described in this video. The third thing you need to do is note the response deadline printed on each notice. Calendar it. Put it somewhere you will see it every day until you have addressed it. IRS deadlines do not bend for circumstances the agency was not informed of in writing. The fourth thing you need to do is contact a tax professional, a CPA, an enrolled agent, or a tax attorney if you need assistance responding to any notice, particularly a CP 2000. If you cannot afford professional help, the IRS Taxpayer Advocate Service is a free resource available to taxpayers experiencing hardship, and low-income taxpayer clinics, which are federally funded and operate in most states, provide free or very low-cost representation to qualifying taxpayers. You do not have to navigate this alone, and you do not have to pay a large fee to get help. The fifth thing you need to do is create a dedicated place in your home for IRS and tax correspondence. Not the kitchen counter, not the pile of mail by the door. A specific folder or binder labeled IRS correspondence where every piece of IRS mail goes immediately upon arrival and from which nothing is removed until it has been addressed. This single organizational habit eliminates the most common cause of missed IRS deadlines, which is correspondence that was received but not acted on because it got buried. The bigger picture. The IRS enforcement expansion that is driving this wave of correspondence to retirees is not going to reverse. The technology investments that expanded the automated matching capacity are in place. The additional staffing that was funded through recent legislation is being deployed. The categories of cross-referencing that are now generating discrepancy notices were not previously being checked. They are now. What this means is that the era in which a retiree with multiple income sources could file a return with minor reporting inconsistencies and have a high probability of those inconsistencies going undetected is over. It is not that the IRS has become more aggressive, it is that the IRS has become more capable. The same discrepancies that existed 5 years ago and went unnoticed are now being caught by automated systems that operate continuously and that do not have the capacity constraints that previously limited human review. The retirees who understand this and who respond to every piece of IRS correspondence promptly, who verify their return accuracy before filing, and who maintain organized records of their income sources and tax reporting are not going to be significantly affected by this expanded enforcement. They were reporting correctly already, and the matching process will confirm it. The retirees who are going to be hurt are the ones who do not open the letters, who set notices aside because dealing with the IRS feels overwhelming, who assume that no news after the deadline means the problem went away. It does not go away, it compounds. And the additional amount owed after compounding penalties and interest on a problem that could have been resolved with a single phone call and a documented response within the original 60-day window is what turns a manageable tax issue into a $3,000 or $5,000 or larger bill that arrives when you are least prepared to absorb it. Open the letter, read it, know the deadline, respond. One final warning. The scam environment around IRS correspondence is more sophisticated and more dangerous than it has ever been. Fraudulent letters designed to look exactly like official IRS notices are being mailed, not just emailed or texted, to retirees across the country. These letters use real IRS notice numbers, real-looking government formatting, and real-sounding language to demand immediate payment through methods the IRS never uses, including gift cards, wire transfers, and cryptocurrency payments. The IRS will never demand immediate payment by gift card. The IRS will never demand payment by wire transfer to a private account. The IRS will never threaten immediate arrest for non-payment of a tax balance. Every one of these demands, regardless of how official the letter or the caller sounds, is a scam. Legitimate IRS notices give you time to respond. Legitimate IRS payment methods are check payable to the U.S. Treasury, electronic payment through IRS Direct Pay at irs.gov, or an authorized payment processor listed on the IRS website. If anyone is demanding immediate payment right now by any other method and claiming to be the IRS, hang up the phone, do not respond to the letter, and report the contact to the Treasury Inspector General at 1-800-366-4484. If this video gave you information you needed before that letter arrived in your mailbox, please share it right now with every retiree in your life. The response deadlines on IRS notices are already running the moment the letter is sent. Every person who does not have this information is a person who might set that letter aside for 1 week too many and discover what happens when an IRS deadline passes without a response. Subscribe to this channel and hit the bell. We cover every change, every deadline, and every rule update that affects retirees the moment it matters. And if this was valuable, a like costs you nothing and it helps this reach the people who need it most. Know your deadlines, open your mail, and we will see you in the next one.